Yes guys, how are we all doing? Welcome back to the YouTube channel. In today's video, I'm going to give you the 5 common tax mistakes that I see property investors and business owners just like you making that result in them overpaying taxes. Before we kick things off though, please do make sure that you hit that subscribe button and also give this video a thumbs up because you know it's great content and we want everybody to benefit from this. So the first one that we see is basically, it's a simple one. It's one that's probably heard time and time again, and it's incorrect structure. So it's looking at basically the way that you structure your business, especially property investors at the minute. Interest rates going through the roof, mortgage payments probably higher than they ever have been. And as a result, if you're a landlord in your own name impacted by Section 24, a lot of people are seeing it where they are literally paying more in taxes. They're making losses or they're paying more in taxes than they're actually making in profit because of the way the Section 24 interest tax, the tax restrictions on the mortgage interest work for landlords in their own name and partnerships. So absolutely making sure that you have the best structure. If you have a portfolio, can you move it into a limited company? Looking at this and speaking to a tax advisor is essential because ultimately with tax, it's your ownership structure and the way that that business is structured, whether it's, partnership, your own name, LLP, hybrid mixed partnership, a normal company, a smart company structure. That is the main driver of the tax that that vehicle pays. So if you've not got the most tax efficient vehicle to house those investments, then if you don't, you will be overpaying taxes. So that's the first one, having the incorrect structure. If you want to reduce your taxes, absolutely make sure that you have the best possible structure. The second one is basically not claiming as all the expenses is that you can claim. So a lot of landlords miss this out, a lot of property investors miss this out, especially the ones where you might pay for, but you don't even realise. Great example of this, mileage. Because you're doing that mileage anyway, you're driving your car to the viewings, it's quite easy to forget about those expenses, using your home as office, laptops, all the equipment that you're using, training costs, the list goes on, but ultimately not claiming all of the deductions that you're actually entitled to. So it's important that your accountant is giving you a good list, some good resources to make sure you're maximising your deductions, because the more expenses you put through, the lower your profits and the less tax you pay. Number 3 is not paying any interest or salaries out, so especially with a limited company during the early days where you might be doing this as a sideline or you basically want to be reinvesting as much as possible. So you don't want to be keeping the cash in the business, but you know that you'll be bringing it out at a future date. So the best way to explain this is if you've got a director's loan account, you've put money into your business, you could charge interest on that. As a basic rate taxpayer, you get £1,000 a year tax-free, £500 a year as a high rate taxpayer. And even then, if you're a basic rate taxpayer, it makes sense to charge as much interest as you can because, as we'll see from April, corporation tax going up to 25%, whereas what interest is, it's a tax deductible expense. So actually it's going to bring your profits down and you'll be saving tax at 25% there. But if you're a basic rate taxpayer, you only pay tax at 20%. So you're actually saving money and you're increasing the amount that you can take out later on tax-free. So charging interest is an absolute win-win. And the same with salaries as well. Even if you don't intend to take the money out, if you've got your personal allowance otherwise being wasted, whether it's for you, your wife, whoever else is involved in the business, you need to lock that in during the tax year by putting a salary through with HMRC. Number 4 is not involving others. So I was speaking with a new client who's basically coming on board with us. They take all of the money out and they basically pay it personally to their wife who actually does some work in their business. And I said, hang on a minute, if you were to bring them in as an employee, this is exactly how much you would save. A previous accountant hadn't told them to do this, hadn't explained any of this to them. And as a result, they were paying, I think it worked out to be about £3,500 each and every year extra in tax. All of her allowances were being lost and the husband was basically taking all the money out and then paying it to her personally. We said to them, actually bring on the payroll as an employee, and what that would do, allow you to basically pay her salary as a tax deduction and then use all of her tax-free allowances. It truly is a win-win there. Number 5, last but not least, is basically not staying on top of your admin, not filing when you're supposed to. The amount of people that set up limited companies, register for self-assessment, and then forget the deadlines and ultimately get penalties from HMRC. It's unfortunate, but when you set up a limited company, you have legal obligations. You need to stay on top of this because the penalties are significant. If you miss your tax return deadline, that's £100. Light filing of accounts can start at £150, and it just keeps going up from there. So in order to basically minimise minimise the taxes and the fines you'll pay. Get your accounts in way ahead of time. That's all for today, guys. I hope you found this video useful. Please do give it a big thumbs up and remember to hit that subscribe button. Otherwise,